Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. Now, in today's episode, I want to talk about the 10 advantages to having a long-term investment strategy. And before you tune out, in case that doesn't sound like a good topic, I think some of these things aren't obvious initially when people think about, do I need a financial plan? Do I have an investment strategy? And it doesn't necessarily need to be something that a financial advisor puts together for you. It might be something that you have formulated yourself. It's really just knowing where you're heading. And in my experience working with clients, there's a whole bunch of added benefits that they might not initially expect, but they might experience some of them in the immediate term after the financial plan is determined, or they might experience some of these benefits down the track. But I think it's good to sit back and kind of reflect. And the idea for this episode arose when I was reading a blog. I read two blogs every day. One is from Seth Godin, and the guys in my team are sick of me talking about Seth. And the other one is called A Learning a Day. A Learning a Day. In case you want to Google it, the link is in the blog on the website. And Rohan writes this A Learning a Day blog, and I think it's really worth receiving and reading. Anyway, he wrote about strategy, and I'll read it to you, I'll quote it. The definition of strategy that I use in my day-to-day is a good strategy is defining the right sequence of steps that helps us navigate trade-offs to achieve an end outcome. End quote. And I thought this definition was really perfect when it comes to building wealth. Because first you need to have a clear goal, whether it's to retire or something else, how much living expenses do you need, those sorts of things. And then there's a series of steps, but you need to take them in the right order. That's really important. And then finally, there's going to be trade-offs, such as potentially cutting back on spending, luxuries, these sorts of things. But it's important to know that sacrifice is worthwhile. So it got me thinking then, what are the 10 benefits of having an investment strategy? And a lot of these have, as I said, come about from our experience of working with clients, and some of these aren't particularly that obvious. So let's get into it. The first one is that it provides context for making future financial decisions. So, if you come up to me and ask me, look, can I afford to upgrade my home? Can I afford to, go back to working 3 days a week, for example? Can I afford to send my kids to private schools? Can I afford to go on a, European holiday every 3 years? These are the sorts of questions that are really difficult to answer without the context of a long-term investment strategy. If I fully understand what your strategy looks like, how much cash flow is required, what is required from a borrowing capacity perspective, what is required from a time perspective, so what is your investment time horizon, just those sorts of factors, then I can measure the impact of doing these things. So that is, if we're going to upgrade the home, I know that's going to pull more cash flow out because potentially, obviously, we need more debt, more non-tax deductible debt. And I can easily measure what is the financial impact on lifestyle and financial goals as a result of making those decisions. But without a strategy, of course, you're kind of flying blind and you don't really know, well, I'll just upgrade the home. Now, that could be a great decision. It might end up being a costly mistake. But the problem is you won't find out, and that won't be apparent probably until many years after you've already made that decision. So context is a big one. Second benefit is it forces you to define what you're working towards. See, you don't need a strategy if you don't have a goal. And I would argue that everyone should have a goal. Everyone's getting somewhere. At some point, we're going to want to retire, I think, or at some point, we want to have the flexibility to retire or even reduce working hours. Most people are going to be in that category. And so therefore, everyone kind of needs a goal. You need to know where you're working towards. Now, the goal doesn't have to be ultra specific. It could be just at 60, I want to have the ability to not work and spend $120,000 a year on living expenses. Or it could be less long dated than that. It could be, look, I want to upgrade to my dream home in 10 years' time, or I want to get into the property market, or I want to become debt free. Again, these goals don't have to be, all about retirement, but we've got to be kind of working somewhere. As the saying goes, if you don't know where you're going, any road will get you there. But that sort of approach when building wealth is really risky because you're liable to be distracted by shiny objects. You'll end up making short-term decisions because it's too hard to make a long-term decision if you don't have that long-term outlook. So really set a goal. Any goal is better than none. And it's funny when a lot of clients approach us, they know they need a financial plan, but defining the goal is the first step. Quite often they haven't defined that goal, but they certainly know they need a financial plan. So, that's one of the great things that kind of comes out of it. It really forces clients to start thinking about, okay, so where are we heading? What does retirement look like? Do I really want to stop working completely at age 60? And these sorts of questions. The third benefit is that you make sure that any trade-offs are worthwhile. Most investment strategies come with some level of trade-offs because building wealth requires normally a consistent level of capital for you to commit, some amount of surplus investable cash flow. And that could go towards, holding investment property costs, making super contributions, investing in the share market. Doesn't matter what it is, but if there's no contribution from you, really difficult to, create wealth out of thin air. Now, of course, though, the alternative is that you could use that money for other things, buy more stuff to put in the cupboard, travel more, enjoy more luxuries. So, of course, there's going to be some trade-offs. And in some situations, the trade-offs can be significant. So some clients need to go through kind of a bit of a period of austerity where they're really pulling in their belts as much as possible and limiting the amount of luxuries. But the point is, if you're going to go through a period like that, you want to make sure that it's going to be worthwhile. If I'm going to make some significant sacrifices over the next 7 years, I want to know that the subsequent 7 years I'm going to be much better off for it, right? And that's why having a long-term strategy puts that in context. Now, for most people, I think the goal is to have a good balance. You want to spend some money today to enjoy life, but you don't want to spend it all because you want to invest some money just in case you don't die tomorrow and you need some money for the future. And I think, building wealth is a journey, not a destination. And we really need to have that balance. I don't believe that everyone should invest every single possible cent they can today. Of course, that for most people, it doesn't suit most people, and I just think that's silly. But if you do need to make some trade-offs, you just want to make sure that you're going to be rewarded in the long run, and that's difficult to do without having a good long-term investment strategy. The fourth benefit is that you know what steps to take in what order, and I think that's really important. Drafting a financial strategy is a little bit like planning a road trip. You just don't jump in the car and drive without a map or a destination. You'll just likely waste time, driving around in circles if you like. But if you plan your route ahead of time, you'll know exactly which roads to take, where to stop for fuel, and how to reach your destination in the most efficient way possible. And a financial strategy is exactly the same. So, for example, I typically not recommend, someone in their 30s making additional super contributions if they have a substantial home loan or they haven't yet purchased their forever home. But similarly, I usually suggest investing in property first before you start investing in shares, just so you can benefit from that compounding capital growth. So understanding what financial steps to take in what order is crucial. Decisions like which asset classes to invest in first, how to invest in those asset classes like methodology, how to allocate your wealth across different asset classes and ownership structures as you proceed through your wealth accumulation journey. And a well-constructed investment strategy will make that really clear in terms of which order to do all that work in. Number 5, proactive tax planning is much easier to implement once you have a long-term strategy. It's super difficult to minimize tax if you wait until after the tax liability has been incurred. So, for example, if I go and sell an investment property and trigger capital gains tax, I've only considered then, well, what can I do to minimize my capital gains tax after the event? I might have missed opportunities that I could have put in place before I sold that particular asset. And particularly, it'd be even better to think about capital gains tax before I even purchase that asset. So, when I go to buy an asset, whether it's an investment or a business or something, I need to think about the tax attributes that asset might produce. And then even if I don't expect it's going to realize a big capital gain, you still even keep that in the back of your mind. So you think about all these things: income tax, deductibility of any negative gearing, capital gains tax, land tax if applicable, any other taxes, GST, these sorts of things. And then you want to think about then how is that asset going to play out over the long run before you even buy the asset. That's the best time to really do that strategic tax minimization strategy. But if you take a piecemeal or ad hoc approach to building wealth, you don't always get the opportunity to do that because different assets are going to behave differently, and you want to, at a portfolio level, try and achieve a perfect balance of tax minimization. You might not be able to do that perfectly for each individual asset, but I'm really just talking at a portfolio level. So even decisions around, well, how much of my wealth am I going to hold inside super? How am I going to maximize the benefit of the transfer balance cap, which is the amount you can have in super with that's going to be completely tax-free? And knowing that I might not necessarily be able to, I'm not just going to solely focus on super when I'm 25. Of course, that doesn't make a lot of sense because a lot of things could change between then and when you reach 60. So again, you want to have that long-term strategy to try and ensure that you pay as little tax as possible to really make it as tax efficient as possible. And that's one of the great benefits. Once our holistic accountants really know what the strategy is, they can run the ruler over it from a taxation perspective and identify all the key elements to make sure, with the advisor, of course, to make sure it's perfectly tax efficient. The sixth benefit or advantage is you can clearly articulate or know how you're able to help your family and when it's right for them, when it's right for you. See, a lot of clients tell us one of their goals is to help their kids get into the property market. Of course, if they've got kids, or at least get in a position where they can help them financially should they need that sort of help. But the challenge is you can't really predict when or even if your child will want to buy their first property, how much that property will be, where that property will be, their financial capacity at the time, and all these sorts of things. So you don't want to help them in a way that jeopardizes your own retirement either. It needs to be affordable to you. That said, most people that receive inheritance too late, after they're already financially established. And so that can be a missed opportunity as well in terms of not providing an early inheritance, because if we're able to help kids when they're in their late 20s, early 30s, or when they're heavily indebted and they've got a young family, so, their income earning capacity is reduced as well, that's when people kind of need that financial help. Although, sometimes that financial struggle during periods of our life builds resilience and rite of passage and gives them a sense of accomplishing something. So, that's important too. You don't want to rob them of the opportunity of feeling in that way as well. But having a long-term strategy in place helps you better understand your capacity to be able to assist your children, when to offer help and how to do so, whether that's through making a financial gift, offering a family guarantee in terms of security for their loan to get them under the 80% loan to value ratio, or some other method. The most important thing is it gives you the confidence of knowing that you're not going to put your own retirement at risk, and to what extent can you help children or other family members. The seventh benefit is it avoids asset allocation mistakes because you can start with the end in mind. So by the time you're ready to stop working, or you'd like to have the flexibility to stop working, the perfect situation would be that you have a well-diversified portfolio across various asset classes. So that might include property, shares, cash, bonds, fixed interest, these sorts of things. It means that by the time you get to that point, your assets are held really tax efficiently, as I said, trying to maximize the tax-free benefits of super. So soon to be $2 million per individual inside super that's going to be tax-free, ensuring your level of debt is manageable, ensuring your cash flow is not overly sensitive to changes in interest rates, performance of any particular markets as well, these sorts of things. So that's really the finish line, if you like, from a portfolio construction perspective, because the asset allocation over that period of time, of course, is going to change. But by the time you get to that point, which might be age 60, whatever it is, that's really what you want it to look like. For example, when you're younger, you're probably going to be more heavily invested in property. And that makes sense because, the sooner you get into the market, the sooner you can benefit from that compounding capital growth and potentially hold an asset for 30 or even 40 years, and that's really where the most of the returns are going to come in that last. If you hold it for 40 years, 80% of the returns probably going to be in the last half of that time period, and so you really want to benefit from that. So it's not unusual then to find people in their 30s, early 40s are almost fully invested in property. Of course, as you build those assets in property, then you start thinking about, or your superannuation in terms of balance, starts to become more substantial. You invest in other assets like shares and so forth. So it's difficult to achieve a perfect asset allocation over time, but it's really the focus on that end point, making sure that you do have that right asset allocation. And of course, if you want to have the flexibility to retire before you're 60, before you can access super, then you need to make sure also that you're going to have enough assets outside of super in order to do that. But having said that, you still want to make sure then when you are 60, what is your strategy to get all those assets or as many of those assets inside super so you're not going to pay as much tax? But the seventh benefit is just making sure that you don't end up making mistakes, in terms of asset allocation mistakes, that you end up by the time you get to 60 or whatever that age might be, that you do have an appropriately allocated asset allocation from a wealth accumulation perspective. And that might require you to make different decisions 10 years prior to that, in your 50s or 40s or whatever it might be. But having that long-term plan at least allows you to do that. The eighth benefit is it allows you to work out how important super is. Now, I keep talking about super just because it's a really good example of the benefits of a strategy in that it's a great ownership structure from a taxation perspective, but has some limitations in terms of when you can access super and how you can access super and all those sorts of things. And that's why it's important, because of its lack of flexibility to some degree. That's why it's important to plan. Now, the reality is most people don't really start paying a lot of attention to super until they're sort of 10 or 15 years away from retirement. I think more younger people today are more concerned with super than they used to be, say maybe 10 or 15 years ago. And I think that's a great thing, of course. But, if you only wait to sort of 10 years before you're retired, you potentially have some missed opportunities there. I know I've mentioned it a couple of times, but if super is going to be an important role in your retirement, and that means that if you have no intention of wanting to stop work or reduce working hours before you're age 60, then you really want to think about, how do you get as much money into super as possible? Now, if you're very young today, if say you're in your 30s, at today you think, no, definitely I'll work till 60. You've got to leave room for the possibility things can change, right? So I wouldn't be too focused on super. But conversely, sometimes people, just sort of ignore super and think, look, it's not a big deal. It's not going to play a role. Be careful about that as well. And because we've got caps, contribution caps, it's not like you can go, well, I'll ignore super and when I'm 50, I'll start looking at it, because you miss the opportunity of gradually drip feeding money into super and taking advantage of those caps. And you can only go back, if you've got less than 500,000 in super, you can only go back 5 years in terms of any unutilized concessional contribution caps. So that's the problem, is that there's an opportunity cost of ignoring super in your 30s, because you might look back in your 50s and go, well, I should have put 10 grand a year for the last sort of 20 years into super. I'd be in a completely different situation. Now, of course, if you want to retire before you're age 60, then super's not going to play a role in the first phase of retirement. And in that situation, it might be totally correct to ignore for a period of time any investments inside super. But we've got to then think about the longevity risk, right? So if, people today in their 30s, they're probably going to live well into their 80s, 90s, potentially beyond 100. So you've got to think about that longevity risk. And in that situation, super will play a role. So I think it's very important in every strategy. We need to ask ourselves, how important or what role will superannuation play in this retirement strategy? And then that gives us context for making decisions today in regards to, what we want to do with that super, how we're going to invest it. Like I've spoken about in the last couple of weeks, do we include some gearing inside super? Is there a real benefit in doing that? Those sorts of questions. The ninth benefit is that you don't waste money on insurance. And I'm talking about personal risk insurances like income protection, or sometimes called salary continuance, life insurance, total and permanent disability insurance, trauma insurance. These sorts of products tend to be critical for a lot of people to obviously protect their own position and financial position and wealth strategy, but also protect any surviving family members that are financially dependent on them as well. But it's no surprise that insurance premiums keep rising. I think every insurance premium keeps rising. And every year we get the bill, we think, oh my God, this is so expensive. It's 20% more, that costs 20% more than last year. Do I really need it? All these sorts of things. Well, a well-defined financial plans helps us understand the level of coverage we need throughout our financial plan. So in times where, we've got a sole income earner, because we've got one spouse who stay at home looking after the kids, we're heavily indebted, we're starting from a relatively low asset base because we've just started the investment journey. A person in that scenario typically needs a lot of cover. But that's okay because they're probably in their 30s and cover's relatively cheap. But obviously then as they move through their investment journey, maybe towards their late 40s, early 50s, they've probably got a lot less debt. Kids are getting closer to being financially independent, hopefully. They've got a stronger asset base. Maybe they've got two income earners in the family now. And so they probably need a lot less cover than what they needed in their 30s. And certainly by the time they get deeper into their 50s, arguably, hopefully, if everything's gone right, they're in a position where their asset base is strong enough to sustain a situation where one person's income is no longer earned, maybe because of incapacity or because they've passed away or whatever. Arguably, there's no need for insurance. So it's difficult to give insurance advice if you really don't know what the long-term plan is and how the asset base will change over time. And so what you really want to get is the most value for money. So when I need the cover and the cover's relatively cheap, relatively affordable, then of course I should have it. But I want to have a plan then on how I'm going to gradually reduce my insurance cover as the premium increases. And so the cost benefit is less attractive than it was, say, in my 20s and 30s. And having a clear plan really is the best way for us to be able to give a client insurance advice, because we can jump into the financial model and go, well, if one spouse wasn't to earn an income, will this strategy still work? And if the answer's yes, then potentially we don't need cover for that particular spouse, for instance. And the 10th benefit of having an investment strategy is that, there's that saying that life is what happens while you're busy making other plans. Well, a good investment strategy should be flexible enough to adapt to different circumstances, whether it's a change in income, a change in your financial situation, unexpected opportunities, these sorts of things. Having a strategy in place gives you a framework to kind of reassess your goals and adjust the strategy if needed. So it ensures you stay aligned with those sort of long-term objectives, even if those unexpected changes arise, making sure you're still going to hit on those key lifetime goals like enjoying a comfortable retirement. And so a strategy gives you that safety and that sort of context for doing that. I thought I'd throw in an 11th advantage, and it's a little bit cheeky, but really the bonus advantage is, this is what I was really thinking about when I was thinking about this episode, is it can go on more holidays. I mean, who doesn't want to go on more holidays? So what I'm really saying here is that a really astute investment strategy allows you to confidently balance living for today with saving for tomorrow. Now, none of us know how long we have left. So, of course, it's not wise to forgo all enjoyment today in the hope that you live long enough to enjoy the rewards of all your hard work. But at the same time, we can't live as if we're going to all die tomorrow. It's about finding that balance, and it's really about enjoying as much as you can today, but not without putting your long-term plans at risk. And of course, there's no point really dying with a whole bunch of money in the bank, more than perhaps what your children or beneficiaries will ever really need. Arguably, I mean, some people, that's their goal, and that's fine. But for most people, they would say, well, I should have gone on another holiday, those sorts of things. And I think having a good long-term strategy allows you to do that guilt-free, which means that if you're in a situation where you've got a strategy and you're 5 years into that strategy and you're doing better than what you thought, and you've got some surplus cash flow, you've got some surplus cash savings, why not go and spend that on a holiday, for instance, because you know you've already done the hard work of and what you should do, and you know you're in a better position than what you would have or that you expected to be when you started that investment journey. I know personally for me, it empowers me, gives me a good sense of satisfaction as well, that I know that if I've hit all my goals and I've invested a certain amount or everything that I wanted to invest this year, and I've got some more that's left over, I have no problem whatsoever of saying, let's just go on a great holiday and enjoy that money today or do whatever we want to do, whatever it's normally some sort of experience, because I think, you need to find that balance. And I think that's one of the greatest things of having a long-term strategy is it allows me to really enjoy my life as much as possible without putting the future at risk, but also not putting at risk, regretting not living a bit more, when I'm sitting in my rocking chair when I'm in my 80s or whatever it might be. Okay, let's summarize them. Gives you context for making decision was number one. Number two, forces you to define a goal, so at least you've got something to aim for. Number three, make sure any trade-offs are worthwhile. Number four, you can work out what steps to take in what order. Number five, much better position to do proactive tax planning. Number six, you have a clear idea of to what extent you can help family and when and how. Number seven ensures that you can make decisions today so that you are going to end up with an adequate and efficient asset allocation by the time you reach retirement. Number eight, how important is super within your overall strategy so you can make some decisions there, particularly when you're younger. Number nine, you don't waste money on insurance. So it allows you to optimize insurance cover over the lifetime. And number 10, should be flexible enough to accommodate changes in life. So hopefully you enjoyed that episode. Hopefully some of those advantages weren't particularly obvious to you. As I said, quite often when working with clients, these things, these advantages or benefits are highlighted after the fact, they don't expect them. And that's why I thought it was worthwhile sharing today's episode with you. All right, let's get into some listener questions. First one is from Shane. Hi, Stuart. My wife and I are in our early 50s and planning to move to the next stages of our lives in our early 60s. In brackets, we don't like the word retirement. We have been discussing different strategies on where we will live when we eventually downsize our primary place of residence, as we plan to spend 10 years focused on long stints of travel overseas. We've been exploring the option of purchasing a downsizer home now for the following reasons. One, buying at today's prices, avoiding the fact that it's probably going to cost more in the future. Number two, incur upfront capital costs while we're still working full time. Number three, reduce the impact on the proceeds from the sale of the home in the future. We should have more funds available from the sale of our home if we sell in 10 to 15 years after we buy a downsizer property, obviously looking at an investment grade property at a townhouse. Number four, can double as an investment now and a future place to live in the future. We'll also rent the downsizer property out while we're traveling. And number five, we can take our time to select the right place and avoid the complications of selling and buying at the same time when we eventually do downsize. I realise that life changes and plans change, but it seems to make sense to us to buy a quality investment now to avoid paying more in the future, especially as we know what lifestyle needs are. I'm interested if this strategy has merit and if you think there are things that we have not considered and should. And for context, Shane's shared some information about super balances, home value, they've got investment property and so forth. Not particularly relevant, I guess, to my answer, but thanks for sharing it for context, Shane. So it's a really good question. And I would say that I've got some experience in terms of how this plays out. It's very difficult. So my observation is it's really difficult for clients to anticipate what they'll be thinking when they're fully retired. It's a really interesting one and probably more of a psychological, obviously, than a financial sort of decision or consideration. But I find it interesting that, so actually it's probably easy if I just explain what I observe. People have some ideas when they're working, and that's fine. That those ideas don't tend to change very much. So for example, for Shane's probably talking about in sort of 10 years, retiring. Over the next 10 years, Shane might think, I'm going to buy a townhouse in this location, and that's probably not going to change, right? I acknowledge that. In the first 3 to 4 years of retirement, I tend to find that a lot of ideas can change during that period. So when the person initially goes into retirement, they tell me this is what retirement's going to look like. 2 years later, that's probably changed. And 2 years later after that, that can change again. And so it can be therefore really difficult then to buy a downsizer today, because who knows how much travel you want to do, whether you're healthy enough to do that travel, how investment returns will play out, because, in 10 years' time, you could end up with a lot more money than you expect. And so you want to do a lot more traveling. So it's really difficult to make those decisions. And that's the main caution that I would say. So other than that, all the other benefits that Shane has mentioned in terms of getting in the market today, hopefully buying a property with an investment lens, it'll make a good investment property as well as generate growth. It will realize then more net sale proceeds when they eventually do downsize, because they're bought at today's prices rather than prices in 10 years' time. So all the benefits that Shane's identified are bang on. The main problem, though, is knowing where you would like that asset to be and whether your position will change over that time. Now, I guess if Shane told me, okay, this is the other factor too, right? Where is your family going to be? But I was just about to say, if Shane told me all my kids live here, they're well established, we want to be close to that, close to grandchildren when they eventually come, etc. Maybe then Shane can tell me with very high level of confidence where he'd like to live. In that case, I'd say go for it, Shane. I think it's a great strategy. But if there's any uncertainty, and in my experience, there probably will be, unless there's this compelling sort of family thing that's pulling you in a particular direction or location, then it's really difficult. And that's the other problem too with kids. When you've got kids that are young adults, they could end up being anywhere. They might move to a different state, and all of a sudden you want to spend more time in that state. I have a client exactly in that position, for instance, and they've only been retired for about 5 or 6 years. So that's why I say it's really difficult to navigate these things. It's really got to keep your mind open that, your potential outlook could change. And then you don't necessarily want to go and buy a property today and have to sell it in 10 years' time just because it doesn't suit your situation anymore. Okay, next question. The next listener writes, I've been working my way through the back catalogue of your podcast and feel like I'm learning a lot. That's awesome. I have two questions and prefer you not to use my name if you answer them on the podcast. Okay, so the first question is, I'm a 45-year-old school teacher earning an average wage and would like to maximize my super returns. You have mentioned the benefits of using a wrap platform for reduced fees and maximize tax efficiency. However, this would not be recommended for me due to the high cost of financial advice and the limitations of my investment knowledge. I know that you would not recommend this, but what do you think of a self-managed wrap platform with ChatGPT giving advice on the index funds to invest in? It's funny the listener's written the question to me with the premise, I know you would not recommend this. I don't recommend it. I can't really think of I'm sure there's worse ideas out there. I'm sorry to this listener, but that's a terrible idea. It's really funny with AI. Even I was just communicating with someone this morning about this, even asking AI a tax question that is actually terrible at answering tax questions. What you have to do really is ask 3 or 4 different AIs the same question. So it might be ChatGPT, Perplexity is another one. And then you might ask, Copilot or something like that. Ask 3 or 4 different, if the answer is the same, then maybe you can get some confidence that that's the right answer. But, just don't rely on AI for tax questions. They are wrong a lot more than they are right. And the same would be for investment advice. Keep it simple, people. Yeah, sure, there's some tax benefits associated with having a wrap platform. But as I've said many times, you need to balance out everything. You need to balance out returns, the amount of time that you're going to spend on it. You've got to balance out risk. So what is the risk that you're going to make a mistake and completely mess it up? I think for this listener, just go to a really great industry fund, Uni Super, Vanguard Super, one of those, and it'll be really low cost. Returns are good, really simple. Might not be perfect just purely from tax alone, but in the long run, it's probably really the best solution for you. The second question from the listener is, what advice would you give a young person entering the workforce with regards to setting up a super fund? Assume they have no interest in creating wealth for retirement for the next 20 years. That is, what set and forget advice would you recommend for a young person? Just go with Vanguard or high growth option at UniSuper. Yes, to this listener, my answer is yes. Just keep it simple. I wouldn't overcomplicate it. No one knows how life is going to turn out. to what extent will you be contributing to super? To what extent will superannuation play a large role in your retirement strategy? Kind of linked into what I've spoken about in today's episode, but just make the best possible decision today, given so much can change in the longer run. And a very low cost pooled superannuation product like Vanguard or UniSuper, I think is the best solution and exactly what I've told my sons to do. Okay, I might leave it there. Again, conscious of time. Thank you so much for listening. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.